Hi there, welcome to Kneppyinvests. On occasion, I forget to press the record button. I recorded this, well, I thought I recorded this video, and then I realized I didn't. So this is my second take looking at Acumentis, and more than likely, this video won't be nearly as good as my previous video. I was actually quite happy with that particular video. Now, I've prepared about six Appendix 4Cs and 5Bs from the January reporting, quarterly reporting month. I want to get through those and quite a few others. However, I haven't had the time to record these videos. And when I do record these videos and release these videos, more than likely I'll release these videos in the morning. I actually plan to release this video on the Monday morning, 18th of March. Now to Acumentis. Who and what does this company do? Now, Acumentis used to be known as Landmark White. Then they changed the name in late 2019 to Acumentis. And funnily enough, the name Acumentis is derived from two Latin words, acumen, which here means keen insight and sharpness in business, and mentis. So funnily enough, maybe the company should be known or called Acumen Mentis, but they're sort of combined the last part of acumen and the first part of mentis. And mentis means mastery of mind, intellect, reason, and courage. So what do those two Latin words tell us about the company Acumentis and what they do? Absolutely nothing. This company is a property valuation company. That's what they do. Now, I went to the website and I found an interesting little blurb, and I'm going to actually say this blurb ad verbatim. Through organic growth, acquisitions, and the strategic merger of four of Australia's premier property valuation advisory firms, LMW, which is Landmark White, Taylor Byrne, MVS National, and Saunders and Pitt, Acumentis has grown to over 300 property professionals. Now, during this video, I'm going to talk about things I like about Acumentis, things I don't like. There's many things I don't like about this company. The first thing I don't like about this company is what they do. And when I say what they do, I compare this company to accountants, lawyers, those sort of companies whose success is reliant on the talent, and that talent is people, property valuers. I'm not sure if there's a massive difference between a good property valuer and a bad property valuer. More than likely, there is a big difference. And if Acumentis wants to be successful, they want to hire the best property valuers out there. And to do that, they probably have to pay pretty high wages to acquire that talent or keep that talent in the business. And that's one of the reasons I don't really like accounting firms, lawyer firms, because labor costs a lot of money. You'll be able to see that if you look at Acumentis's financial statements. They spend a lot of money on employees. So that's one thing I don't like about the company. But there are plenty of other things to like about the company, and I'll talk about those things during the rest of the video. A few other facts in regards to Acumentis, founded in 1905. Now, the company itself, Acumentis, wasn't founded in 1905 because we already know it was a name derived when this company went through this sort of merger of these four premier property valuation advisory firms. So I think Landmark White was founded in 1905, or one of these other merged companies was founded in that year. Listed on the ASX, 5th of December 2003. I'm not sure if that was Landmark White or if Landmark White a reverse merge on the ASX. I didn't want to delve that too deeply into the company. Current CEO and managing director is Timothy Rabbit. March 2019, he's been in that role since. Doesn't have much of a holding in the company, only 0.9%. Probably like a little bit more skin in the game. That's probably another slight red flag I have in regards to Acumentis. Largest shareholder is the non-executive director, Leslie, that last name, which looks like a Polish name. And I always completely mess up Polish names unless they're fairly easy. But that has two Zs in it. And CZK, Wozniacka. Wow, see, I've already messed it up. And that person, Leslie, owns 12% of the company. So it's good to see a non-exec director owning 12% of a company. Now, where it becomes interesting in regards to Acumentis is the valuation. This company has a market cap of $16 million. That's at a share price of 7.3 cents. Now, even though there are things to not like about this company, I'm always willing to buy a company, no matter if I don't like the company, if I see a value. And I think possibly there is value in Acumentis at a market cap of only $16 million. And that might become clearer as I go further into talking about Acumentis and looking at some of their numbers, their financial numbers. She has an issue not too high at 218 million, and the ticker for this company is ACU. Now, the whole motivation for me doing this particular video was Acumentis's December quarter results. And the whole reason I was intrigued by these December quarter results can be seen in section 1 and line 1.9, the bottom line here. This company was operating cash flow positive by $1.3 million in this one quarter. Not only that, in the second column, the year to date, the company was operating cash flow positive by $1.6 million. And this company doesn't spend a lot of money, if any at all, in financing and what's the other investing activities, which means most of that operating cash flow fell to the bottom line in terms of increase in cash on hand. So the company, $1.7 million of cash on hand at the beginning of the quarter, and they grew the cash by $1.2 million. Finished the quarter with $2.9 million of cash on hand. The very fact that cash on hand is increasing also is a thing to like about Acumentis. Now, I've already talked about the thing I don't like about Acumentis is they are highly reliant on property valuers. That's the business. And property values more than likely cost a lot of money. I would assume so, particularly if they're really good. And you can just see that with the staff costs. In this particular quarter, this company spent $10.4 million just on staff costs. In the first 6 months, $20 million just in staff costs. But they did generate $16.3 million in receipts in this one quarter. So this company is generating a fair bit of revenue, fair bit of receipts. So this is a real company. Now, another thing to like about Acumentis is the scalability. And you can see that if you compare the receipts growth to spending growth compared to the previous corresponding period. So receipts up $1.4 million compared to the December quarter 1 year ago, but staff costs only up $600,000. Administration costs only up $300,000, and they don't spend a lot of money in other areas. So you can see lease assets only $472,000, no advertising and marketing, no product manufacturing and operating costs. So they spend all their money on staff and administration. So you just compare staff costs and administration costs, only up $900,000. Receipts up $1.4 million. So a bit of scalability, bit of goodness right there. That's exactly what you want to see. You want to see receipts and revenue growing at a greater rate than the company's spending. And I'd say this company has possibly reached that very important inflection point. And if I can see this momentum continuing into the next 2 quarters, this company is looking fascinating, even though I don't like what the company does. Now let's have a look at the receipts history for this company. I started following receipts, fortunes of this company back when they went through this merger and changed the name to Acumentis back in late 2019. Now, if you just look at the first quarter and the last quarter, receipts have grown from 8.7 million to 16.3 million, but receipts can be quite lumpy. And an argument here is if you look at the last 8 quarters, particularly the last 7 quarters, receipts have gone nowhere. Receipts have actually gone backwards because the record quarter for this company in terms of receipts was 16.6 million in the June quarter 2022. But the other thing I'd probably point out is if you just look at the last 4 quarters, so again, sometimes it's all about the time period you're looking at. So if you just look at the last 7 quarters, you might get a different opinion if you just look at the whole history or just the last 4 quarters. In the last 4 quarters, receipts have grown from 13.7 million to 16.3 million, which was their second best quarter this company has recorded. Now, what I want to see in the next 2 quarters is at least 1 record quarter. I want to see the record receipts for this company. Preferably 2 record quarters would be absolutely ideal. And if they can maintain some scale, if they can continue to increase the receipts and revenue at a greater rate than spending, that means this company will become more profitable and will generate more cash flow in their business. And that would mean this company is even looking more cheap than it is right now. But that remains to be seen. I'm not convinced that's going to happen. So I need to see proof. Now, because I'm recording this video in March and we're already actually past the half-year or full-year reporting season of the year, that means we can have a look at how the company performed in the last half year. So this is just the company's statement of cash flows, looking at cash receipts for the half, also looking at operating cash flow, and also the cash and cash equivalents at the end of the period. One thing you'll note, and the other thing I should mention here, they have 3 columns. So looking at the last half year, that's the first column. That's shaded in sort of a yellow orangey color. The second column is the previous corresponding period. So the 6 months or the first half of financial year 23. The third column is a different time period or different time frame. It's looking at a 12-month period or looking at financial year 23. So you can't compare the last half year to the full year or the third column because you're not comparing apples to apples, but it's just good to have that on or in the background just now. So you really want to compare apples to apples. Now, receipts from customers didn't grow all that much. Only went from 30.7 million to 31.3 million. That is a slight red, I wouldn't say a red flag, but a slight concern. But the company was operating cash flow positive 1 year ago, $2 million, is operating cash flow positive $2.5 million in this half year. You might say right now, why is the operating cash flow in the half year report different than the Appendix 4C? So if you go back to the Appendix 4C, it was only 1.58 million for the year to date. These are unaudited results. The half year results aren't audited results. So there might be a slight differences between the two. And the half year results are actually better, 2.5 million than the quarter results, which was only 1.5 million. And again, I've already mentioned this company doesn't spend a lot of money investing activities and financing activities. That's particularly true in this half year. In fact, they only spent $374,000 in investing activities, $143,000 deferred consideration paid, $127,000 in capital expenditure. That's nothing to like about this company, a capital light company. And again, the main reason behind that is the talent is in the labor, the property valuers, and only spent $906,000 in lease liabilities. So not a lot of spending in those two sections, which means a lot of that $2.5 million in operating cash flow fell to the bottom line. And that's why the company at the end of this particular half year had almost $3 million of cash, which is significantly higher than 1 year ago. So 1 year ago, this company only had $788,000 in cash. In fact, if I went back into my time machine and I looked at this company 1 year ago, I'd be a little bit concerned about the small amount of cash this company had on the balance sheet. Now, I think I've already mentioned that Acumentis is highly acquisitive. They do quite a few acquisitions. In fact, this whole company was the merger of 4 different property valuation firms, and they do make acquisitions quite commonly. And that is one slight red flag, one slight thing to be wary about this company. And I like to see organic growth. I don't want to see a company growing through acquisitions. I don't like the roll-up model because the roll-up model only works for a certain amount of time. I need to see organic growth. Now, one of the most recent announcements this company has made after they released their Appendix 4C was on 29th of January 2024. They acquired another company, acquisition of business and assets of Gilwright and Associates Business Valuations. Now, the main thing when I see a company make an acquisition is how much they paid for that new acquisition or that new firm, and that is found towards the end of this particular announcement. The acquisition will be paid in cash. That's a good thing. That's a reason why for a company to generate cash in the operations, it's very beneficial. You can pay acquisitions through the cash you generate in the operations. That's exactly what Acumentis has done. So 40% of the consideration payable upfront and the balance over 3 years in contingent on the post-acquisition performance of GWA. Total consideration payable is not expected to exceed $300,000. This was not an expensive acquisition. In fact, this sort of acquisition is not that, I wouldn't say not that important because they're only paying $300,000. So you wouldn't think that this acquisition or Gilwright and Associates would add much to the underlying business of Acumentis. So even though this is another acquisition, unless they make a lot of these sort of acquisitions, I'm not too concerned about this particular acquisition. Now let's have a look at the chart for Acumentis. In fact, this is a 3-year daily chart. The reason I can show you 3 years is because there are periods of time when Acumentis is highly liquid. There's not much trading going on. In fact, there are some days where zero trading is going on for Acumentis. So if you are a trader, this is definitely not the company to be in because you want a company to be highly liquid, not illiquid when you're trading because you want to get in and out sometimes straight away. So one of my rules when it comes to trading is I want to see I only trade in highly liquid companies. So again, I can get in and out really quickly. So more than likely, if you want to buy into Acumentis, it's for the longer term. You think there might be some value in this company right now. not a short-term trade. Now, there are some interesting things when it comes to the chart. There was a period of time here when it was not so interesting because the share price was in a long-term downtrend. Share price reached a high of 18.5 cents back in late 2021. Then it moved into a downtrend, which is understandable. During that period of time, a lot of companies like this had moved into a downtrend. The market just did not like companies that were burning through cash and were not profitable. That's why the share price of this company fell from 18.5 cents all the way down to a low of about 4 cents or just above 4 cents. That low was actually reached in late or middle of 2023. So not that long ago, about 9 months ago. That's when the share price of this company reached low. At that point in time, the share price was still in a downtrend, but it looks like more than likely that is the bottom in Acumentis' share price because share price looks like it has been consolidating. Now, I did show you two charts in the technical update video that I released late on the 17th of March. Fairly similar setups than this. And those companies were Enero and CleanSpace, where the share price has been consolidating. Here, the share price of Acumentis has been consolidating for about 8 to 9 months, trading between about 6 cents and about 7.5 cents. And recently, it looks like Acumentis is wanting to move into an uptrend. And I think one of the reasons why is because of the half-year results. The company is profitable, is operating cash flow positive, free cash flow positive, and potentially certain portions of the market is starting to or has discovered this company. And that's why you can see a little bit of bump up in the share price. Not a big bump up, but a little bit of bump up in the share price in the past month or so. Not only that, we have started to see some big volume coming in. That's another sign there are certain portions of the market starting to discover this company, or maybe not only discover this company, realize maybe there is some value in Acumentis. Now, I'd like to see further proof of that. The first thing I'd like to see is whether the company can continue this momentum, continue to be operating cash flow positive, free cash flow positive, and profitable through the next few quarters and the next half year. And maybe if I want that proof, I'd have to wait, and maybe the share price will going to run, or if the share price breaks up above 7.5 cents. It tried to a few trading days ago, but it didn't quite. And if the share price can break out, if the company can release some really good financial news, if we see continued high volume or even an increase in volume, that would be a bullish move for Acumentis. So definitely, I'm going to keep an eye on the fortunes of this company moving forward. That is all I have for this take two on Acumentis, looking at the December quarter results and also the half-year results as well. There are things to like about this company, also some things not to like, but again, maybe I'm being a little bit too harsh on the company. And even though I don't necessarily like what they do because they're highly reliant on people, and I don't really like that because people cost a lot of money, there is potential value in this company. The market doesn't rate this company too highly. Market cap of only $16 million, but this company is profitable. The company is generating cash flow. In fact, $2 million of cash flow just in the last half year. If they can replicate that performance for the full year, this company could be trading on 4 times free cash flow, which is or means this company is not that expensive right now, particularly if they can grow in the future. This company could be looking really cheap right now. Anyway, that's what I'm going to talk about for this company. If you are a shareholder or have some questions, some thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for the video. Have a good day. Bye.